Welcome to our webinar series on New Jersey tax reform. My name is David Gutowski and I'm joined by Matt Setzer. We're lawyers with Reed Smith State Tax Group, which has over 40 lawyers, CPAs, and paralegals nationwide who do nothing but state tax. We have 15 lawyers that are licensed to practice in New Jersey, which makes us one of the largest New Jersey tax practices of any law firm. Today we're going to be discussing combinations' effect on NOLs, dividends, and tax credits. Matt, what's the first topic that we're going to cover?
So the first topic today concerns combined group losses. As the question lays out nicely on the slide, are combined group losses pre or post allocated? One of the major shifts in the statutory amendments concerns the switch from pre-allocated to post-allocated losses in New Jersey. So an NOL is still defined as the excess of deductions over gross income used in computing entire net income, the tax base. But now instead of taxpayers taking NOLs pre-allocation, they must do so post-allocation. Now, a switch in combined reporting necessarily leads to the question of what happens to losses that companies generate prior to that switch. Dave, do you want to discuss New Jersey's approach to those losses?
Yeah, sure. So for NOLs that are generated prior to the switch to combined reporting, companies must perform a calculation to convert those losses from pre-allocated or in New Jersey uses the word allocation to mean apportionment, and the rest of the world uses the word apportionment to mean apportionment. So we'll try to stick to the convention that allocation means apportionment, but pardon us if we switch back and forth a little bit. So anyway, you have to perform a calculation to convert your previous NOLs to post-apportioned or post-allocated losses. The slide here shows how this calculation works. And here's the definition for each of the terms that are referenced on the slide. So a UNOL is the unabsorbed portion of a net operating losses that wasn't deducted in periods prior to the 2019 effective date of combined reporting, but that were carried into or would have been carried into 2019 but for combination. So the base year means the last privilege period ending prior to July 31st, 2019.
So for a calendar year taxpayer?
2018. The base year, BAF, means the taxpayer's business allocation factor for the last privilege period ending prior to July 31st, 2019. Again, if we want to simplify this, it simply means your apportionment factor for 2018. New Jersey had a single sales factor in effect for that year. So it's just your sales factor for 2018. So how do you compute your NOL that carries into the post combination years? You simply multiply your unabsorbed losses prior to 2019 by your 2018 allocation factor or apportionment factor, and that becomes your PNOL carryover into 2019. Now, it's important to remember that the carryover for the PNOL is limited to 20 privilege periods following the date that the loss was generated. So it's not 20 years from 2018 or 2019. It depends on when your loss was originally generated.
And that's important too, because for some other jurisdictions that switched to combined reporting, those jurisdictions restarted the clock on when those NOLs expired. New Jersey is not doing that. You're looking to your initial loss period for calculating how far that carryover goes.
Right. So you must, if you had to say a 2011 loss, you're going to have to absorb that PNOL that you carry into the combination years by 2031, or else it'll expire. So a couple of other notes: the PNOL can only be used by the entity that actually sustained the loss. It can't be shared among other members of your combined group. And in addition, the PNOL needs to be subtracted before the regular net operating loss deduction. So there's an ordering provision there. You take your PNOL first, and then any post-combination NOLs come second. The PNOL computation does have some issues that get created for taxpayers. One is the calculation requires taxpayers to compute their PNOL generated in a particular year using an apportionment factor from a complete different year. So, in other words, the year of the loss and the year of the apportionment that you use to carry that loss forward are not the same.
And going back to your example of 2011, for example, you have your PNOL that's being calculated by a 2018 apportionment factor. But in 2011, when you generated that NOL, New Jersey was a sales, property, and payroll factor state, so three-factor apportionment, now switching into just sales factor.
Yeah, so by definition, most taxpayers are going to see, at least for years prior to 2014 when the switch to single factor was complete, you're going to have a mismatch of apportionment, not just because your activities may have changed, but because the underlying apportionment rules have changed. Now, if you're based outside of New Jersey, that may be good for you. Your apportionment in 2018 is likely higher under single sales factor than it would have been using the three-factor formula. But if you had a lot of property and payroll in the state in the year that you generated a loss, obviously you're going to be in the opposite position. In those cases, you may want to ask the division for some sort of alternative apportionment. Under New Jersey's rules, it's called Section 8. It's any time that the regular apportionment provisions don't quite match up with your activities, you can ask the division to provide some sort of alternative remedy or alternative relief.
So based on what you were just saying, Dave, there obviously are some issues for taxpayers in calculating their PNOL. One is the obvious mismatch between the apportionment used to calculate the PNOL and the apportionment that a taxpayer uses when they generate the NOL originally. So going back to your example of 2011, if you have a PNOL stemming from 2011, that is, if you still have an unabsorbed loss from 2011 that you could have carried into 2019, you're using 2018's apportionment factor to calculate that PNOL, when in 2011, you were calculating your apportionment based on property, payroll, and sales, three-factor. 2018, you're calculating it just by sales.
Yeah, so obviously there's going to be a difference between what your apportionment was in the year you generated the loss, as long as it was not just based on a difference in your activity, but almost invariably based on the difference in the statute. With the single sales factor transition becoming complete in 2014, if you've got a loss year prior to 2014, you're going to be, having a loss that was generated in the year where your regular apportionment was based on property, payroll, and sales, and now you're taking that loss and apportioning it for purposes of carrying it into the combination years using an apportionment factor that is based solely on your sales. And what you obviously want to do is have the highest apportionment you can in 2018, at least with respect to how you carry forward those losses.
The inverse of what you would usually want.
Yeah, normally. But so if you've got a single sales factor in 18, that's probably good news for most out-of-state companies that had fairly low property and payroll in the year that the loss was generated. So you're taking a loss when maybe your factor is 2%, and now you get to apportion it forward using an apportionment factor that's could be double what it was in the year of the loss itself. Now, on the converse side of that, if you're a New Jersey-based company, your property payroll may have been fairly high in the year that the loss was generated, and now you're using a much smaller apportionment factor to carry it over into the combination years. So if that's your situation, if there's a mismatch in your apportionment in the year of the loss versus the year that you apply the apportionment to carry it into 19 and forward, you may ask for some sort of equitable apportionment. New Jersey, like other states, has an equitable apportionment provision. In New Jersey, it's called Section 8. Anytime there's a mismatch or the apportionment doesn't fairly reflect your activities, you can ask for this sort of discretion. And I think that's the sort of situation you might have here, where the activities in the year of the loss were much greater than what your apportionment provision may otherwise provide for 2018. Okay, so you've already mentioned that we already discussed how the PNOL can only be used by the entity that generated the PNOL itself. Other than group NOLs, other than that, the group NOLs really don't have that many restrictions. As long as what are kind of the parameters here, Matt, of how the combined group can utilize those PNOLs that you carry forward into the 2019 and beyond privilege periods?
Sure. So like you said, PNOL can only utilize it by the member that actually generated that loss, so other members can't use it. But what about regular NOLs, group NOLs that the combined group creates? Generally, those are freely shareable. The only real restriction is if you have a new member that joins the group that wasn't part of the group when a prior group NOL was created, then that new member can't join in on the group loss that was created prior to it joining the group. So another NOL issue for you then, Dave, is what happens when a company acquires the stock of another company? Can the acquiring company use the NOLs of the company that it acquired?
Well, the statute provides a test for this. This is a new rule for New Jersey. The statute provides that where there's a change in 50% or more of the ownership of a corporation, because of the redemption or sale of stock, and the corporation changes the trade or business that had given rise to the loss, no net operating loss prior to those changes may be carried over to or be deducted from income earned after such changes. So Matt, can you summarize that? What does that statutory provision mean in your mind? So
basically, you're looking at when you acquire another company, is there a change in the function of the business by more than 50%? Do you have a retail business moving to something completely different than what it was before? And in those circumstances, the division is going to impose a stricter test than what is allowed by the federal rules.
Yeah, so this isn't a taxpayer-friendly rule. When you compare it to the federal rules, they permit an acquiring company to use at least some of the NOLs of the acquired company. Here, it's just you can't use any of them.
Yep.
But with this restrictive rule, there's a more taxpayer-friendly rule that was also, I guess, thrown in as a bone to taxpayers. And it changed a long-standing statutory and division policy. The rule in New Jersey for decades was that when a merger occurred, the only NOLs that survived the merger were the NOLs that were generated by the entity that survived. So, in other words, if an entity was involved in a merger and merged out of existence, that entity's NOLs were not available, and they just disappeared. So this long-standing rule no longer applies if you've got members between
mergers occurring between members of a combined group.
Right. So this really frees up taxpayers to do a reorganization without having to worry about the unintended tax consequences in New Jersey.
And really, New Jersey was one of the only states that had such a policy. So this is a taxpayer-friendly change. So while we're talking about these long-standing division policies, let's move on to the division's NOL dividend ordering rule.
And these are not just policies. I mean, these were tested by the courts, and the taxpayers lost, and the division's policy was upheld. So we do have something that's a significant change of law here as a result of the combination.
Yep. So the NOL dividend ordering problem for taxpayers by statute. Dividends absorb a taxpayer's NOLs. That's because dividends are included in income, and the dividends received deduction is taken after the NOL deduction in New Jersey on that CBT 100.
So it's an ordering issue.
Yep.
You have a dividends received deduction, but you don't get to use it until you burn through any NOLs first.
Yep.
So it's going to be a real problem for taxpayers that repatriate, for example, large dividends that had a big block of NOLs. They wake up and find that their NOLs are gone. So big problem. And so what did tax reform do to that longstanding issue?
Nothing.
Right.
In fact, it may have created an even bigger problem. That's because not only are group NOLs absorbed by dividends, but under the plain language of the statute, so is the PNOL. And on top of that, the statute doesn't address whether the same dividend income can reduce both the NOL and the PNOL rather than just one of the two. So, for example, say you have $100 worth of dividend income. The question is whether that same $100 can reduce both your NOL and PNOL. Statute doesn't address it. So it's another issue for taxpayers.
Now for that, I don't think that even if you apply the plain language of the statute, it seems that a single dividend would absorb both your prior NOLs and your post-combination NOLs, but I'm sure that the division is not going to enforce that. But that said, there has been no statutory correction of that provision to date.
Correct. So moving on to some other provisions, Dave, do you want to summarize the reduction in the DRD and then also combinations effect on dividends?
Sure. So for tax years beginning on or after January 1st, 2017, instead of getting 100% dividends received deduction, the DRD was reduced to only 95% from dividends that were received from 80% or more owned subsidiaries. Now, if you have less than 80% owned subsidiaries, the rules are the same. You have a 50% deduction for 50 to 80% owned subsidiaries, and no dividends received deduction for less than 50% owned subsidiaries. So for dividends that were paid or deemed paid in 2017 and 18, taxpayers are allowed to use or have to use an average allocation factor from their 2014 through 2016 tax years, or 3.5%, whichever is lower. 3.5%, I think, is just kind of geared towards what is New Jersey's population percentage or GDP. It helps taxpayers who would otherwise have to pay tax on the full amount of the dividend by essentially capping it at 3.5%. So the problem is this creates a potential internal consistency violation if you're a multi-state taxpayer who will pay more in the aggregate than a business that's conducted only within New Jersey. And I guess what we mean by this is, you've got this benefit. Instead of paying 100% of tax in New Jersey, if you're commercially domiciled in the state on that dividend income, you're capped out at 3.5%. But if you're a multi-state taxpayer and your apportionment in any particular state is only, say, 2%, you're paying tax in each and every state on 2%, but in the grand total, you're paying tax on 100% of the income. Whereas the New Jersey only company would get the benefit of that 3.5% ceiling. So finally, when the New Jersey legislature retained the historic NOL dividend ordering rules, dividends are still only absorbed if the dividends are received from affiliates outside your group. That's because under combination, intercompany transactions do get eliminated. So, the dividend problem, the absorption of NOLs, it really is only a problem if you're receiving NOLs from outside your group. But this does set up another potential issue for taxpayers. Because dividends from members within the combined group are eliminated, the only dividends that can be included in your income and that can absorb dividends absorb NOLs are dividends from foreign affiliates, right? So that's because the default election in New Jersey for how to combine your combined return is Water's Edge Group. And so it's primarily going to get composed of domestic affiliates. But how does Kraft apply here? We've got, you want to take us through that, Matt, and how we might have this
Sure.
discriminatory treatment?
So the Supreme Court in Kraft established a rule that states can't treat foreign dividends worse than domestic dividends. If you have a Water's Edge group in New Jersey that is primarily consists of domestic affiliates, and the only dividend income that's being included in that combined group is that of foreign affiliates, this may pose a problem from a Kraft perspective in that you're treating domestic dividends more favorably than foreign dividends.
Now the problem, of course, with that argument is that they're only being treated worse because you elected Water's Edge.
Correct.
And if you elected worldwide combination, you'd get the benefit of eliminating intercompany transactions, including your dividends, so that your NOLs wouldn't get absorbed.
And that's certainly...
How does that impact either position?
Certainly an argument, if this were ever to be challenged, that the division could make, and also an argument that Attorney General's offices have relied on in other states that have had similar types of issues come up.
So do you feel better about taking this as a return position, or is this kind of the sort of thing where you might want to report your tax one way and maybe take it as a refund position?
I'd say that it's probably better suited as a refund position. That way you avoid any penalties and interest associated with it. And then you could take it up to tax court if that is the route that it goes, and see if you get any traction there.
But I guess at a minimum, it's likely that somebody may challenge this. So New Jersey has a 4-year statute of limitations, so it's something that you want to pay attention to in case somebody does challenge it, to make sure that you preserve your rights by filing a protective refund claim.
Right. So finally for today, let's move on to tax credits. Unlike NOLs, members of a combined group can share credits pretty freely. That's regardless of whether you were a member of the combined group when the credit was generated. So now is a good time to dust off those credit profiles to determine if you have any old credits that you thought were trapped in loss entities. Those loss entities can now share those tax credits with entities generating positive taxable income. So unlike, I'd say, combined group NOLs, where you have to look at whether one member was part of the combined group when the loss was generated, tax credits do not have that rule. And things that we have seen issues come up for our clients have been AMA credits. AMA credits that were stuck in entities that didn't have New Jersey apportionment, couldn't utilize those credits, now can utilize those credits and share them freely with the combined group to offset combined group taxable income. So not only a potential issue for taxpayers, but a way to get rid of some of that taxable income.
Yeah, and one thing to keep in mind as well, with respect to credits, even if the year that the credit was generated in was closed, it's still open for purposes of redetermining your income or apportionment to determine how much credit carry forward you have. So it may be worthwhile to take a look at some of those old returns, see what credits were utilized, and whether there's a position that maybe utilized less credits than you originally reported. You can kind of resurrect otherwise expired or lost credits that way.
Thank you for joining our webinar series on New Jersey tax reform today. If you have any questions, feel free to reach out to any of us for any of the materials that we discussed today, or any questions that you have on combination.